So it finally happened. No surprises here. The Fed's up rate. Hey guys, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome to the channel. Let me read what it says and let's talk about what this means for the housing market going forward. This is directly from Reuters. Quote, the Federal Reserve on Wednesday raised interest rates by 0.25 percentage point and projected its policy rate would hit a range between 1.75% to 2% by year's end in a newly aggressive stance against inflation that will push borrowing costs to restrictive levels in 2023. Okay, this is what the market or what most experts were expecting, so no surprises here. In fact, as I shoot this video, the stock market was still up, which means the market sees this as a good sign. The article goes on to say, quote, a new policy statement marking the end of its full-on battle against the coronavirus pandemic, the U.S. Central Bank flagged the massive uncertainty the economy faces from the war in Ukraine and the ongoing health crisis, but still said ongoing increases in the target federal funds rate will be appropriate to curb the highest inflation in 40 years. The statement dropped direct reference to the coronavirus pandemic, but instead cited the war in Ukraine as creating additional upward pressure on inflation and weighing on economic activity. The interest rate path shown in the new projections by the policymakers is tougher than expected, reflecting Fed concern about inflation that has moved faster and threatened to become more persistent than expected and put at risk the central bank's hope for an easy shift out of the emergency policies put in place to fight the fallout from the pandemic. Unquote. Let's unpack this for a moment. The Feds are ending their full-on battle with the coronavirus, which on the health and safety side is a good thing because I feel like this gets us back to normal. Now I know it's not what they were aiming for, but I think it's also a good signal, if you will, that things are turning around. However, on top of what this whole pandemic has created, particularly inflation, now the war on Ukraine is piling on. So we are faced with higher inflation. At least that's what the party line is right now. Blame everything on Russia. And because of this, they are saying that it's looking like inflation will be a tougher battle and will most likely go higher than what they expect. Incidentally, the Feds are saying right now, by their measure, we have a 5.2% inflation. They exclude from their numbers food and energy, which is mind-boggling because that pretty much affects everyone. If you Google what today's inflation rate is, it's actually closer to 8%. Let me just finish off reading the rest of the news. Quote, even with the tougher rate increases now projected, inflation is expected to remain above the Fed's 2% target, remaining at 4.1% through this year and dropping only to 2.3% through 2024. Economic growth is seen at 2.8% this year, a sharp drop from 4% growth projected in December. The unemployment rate is seen dropping to 3.5% this year and remaining there until next year, but is projected to rise slightly to 3.6% in 2024. Yada yada yada, and it ended with the St. Louis Fed President James Bullard was the only policymaker to dissent in the Fed's decision. So, how does this affect housing prices? I believe in the short run, it doesn't right now. We have a housing market of the ones that have, meaning have money and lots of it, and the have-nots, the ones that are struggling. And these people that have money and are well-qualified home buyers far outnumber the supply of homes that we have to sell. So what happens is that any pullback in housing prices gets filled up right away by these buyers that are just lining up to buy houses. I have said before in this channel that 4.5% mortgage rates, we are still good, meaning it shouldn't affect the housing market. I think seeing what's going on right now, I believe that 5.5%, we might still be okay. So the Fed's raising rates won't necessarily affect the housing market right away, and that alone won't have a significant effect because of our insane demand. But with what's going on right now, combine that all together, inflation plus the war, rate hikes, gas prices, that could plunge us into a recession. If we go into a recession and demand for goods and services go down and we start losing jobs, that's when we might start seeing home prices get affected. It most likely will start with rental properties as the average worker starts getting laid off, and then it starts to trickle to your lower price homes. And then the ones that can afford and can qualify for houses starts rethinking their move, whether it's their first time buying a house, or they are upgrading their current homes, or buying second homes or vacation homes. Chances are a lot of these people have money in the stock market, and with the volatility that comes with a recession, most of these well-qualified buyers would also start pulling back. That type of uncertainty, a financial downturn, and Russia showing no signs of ending the war in Ukraine, this is really a possibility of home prices going down. Again, all these forces individually could only have a minor impact on the housing market, but collectively, that's scary. For me, another thing to keep an eye out for is demand. We have right now about 4 million short of housing inventory. If there's a pullback, would we just be filling that demand and thereby softening the blow on prices? Also, with materials and labor costs going up, will builders start to pull back from building new homes because of what they're seeing in the market? And if so, will this also soften the blow on prices going down? I think the answer to these questions might be in 6 months, when things starts to really affect the market. Hey, thanks for watching. I'd like to hear what you think about the Fed rate hike. You think they're gonna do it again next meeting? Have a great day.